There's a number you need to see before we go any further. $1.3 trillion. That's the estimated notional value of outstanding silver paper contracts tied to the global derivatives complex, centered around the COMEX futures exchange and reinforced by the broader OTC market. Let's break that down carefully. On COMEX alone, open interest in silver currently sits around 113,000 contracts. Each contract represents 5,000 troy ounces. That's roughly 565 million ounces of paper claims. At a silver price of $79.98 per ounce, that equates to about $45.2 billion in notional exposure just on the exchange. But COMEX is only part of the structure. Layer on top the over-the-counter derivatives market operating through London, the LBMA framework, bilateral bank contracts, synthetic exposures, and ETF-related unallocated claims. The Bank for International Settlements tracks global precious metals derivatives notional exposure, and the total runs into the hundreds of billions to low trillions. When you combine exchange open interest, OTC derivatives, and ETF-linked paper claims, the total silver promise structure approaches that $1.3 trillion range. Now compare that to what's physically available. COMEX registered silver, the metal actually warranted and immediately deliverable, stands at approximately 77 million ounces. Against 565 million ounces of open interest, that's a 13.2% coverage ratio. In simple terms, for every real ounce sitting in the registered vault, there are roughly 7.5 paper claims. That's not normal inventory leverage. That's fractional reserve mechanics in the precious metals market. And we are 9 trading days away from May 1st first notice day. If even a modest portion of paper holders decided to stand for delivery instead of rolling or cash settling, the current registered pool could not satisfy it at today's price. The price would have to rise to levels high enough to entice physical holders to deliver metal into the system instead of shipping it elsewhere. And that's where the global dynamic becomes critical. Because this weekend, the world's largest physical silver buyer effectively froze its import pipeline. India, not the second largest buyer, the largest. Indian banks have halted new silver import orders. Government authorization allowing bullion imports expired March 31st. As of today, April 20th, no renewed order has been issued. More than 8 tons of silver are reportedly sitting at Indian customs, unable to clear. Banks are not placing new import orders because existing shipments are stalled. India's Directorate General of Foreign Trade has not provided clarity on timing. This isn't a minor bureaucratic footnote. It's structural. In 2025, India imported roughly $9.2 billion worth of silver, up 44% year over year. The 2026 financial year was trending 129% higher. Indian silver ETF inflows recently tripled gold ETF inflows. Several large Indian asset managers temporarily suspended new silver ETF subscriptions due to high premiums and tight bar availability. And on April 1st, India implemented new rules allowing citizens to use physical silver as collateral for bank loans. That's not speculative demand, that's regulatory monetization of silver. So here's the situation. India has structurally expanded silver's financial role while simultaneously freezing its import channel. Demand is building behind a locked door. When authorization is eventually renewed, weeks of pent-up institutional and retail demand hit a global physical market already under pressure. Now let's shift east. Shanghai silver, physically settled, currently trades around $89.58 per ounce. Western spot, $79.98. That's roughly a $9.67 premium, about 12% higher. This gap has persisted for months. In a perfectly efficient arbitrage system, that difference would close quickly. Traders would buy in New York, take delivery, ship to Shanghai, sell at the higher price, and capture the spread. Yet the premium remains. Why? China controls roughly 60–70% of global silver refining capacity. Export permissions are tightly regulated. Only approved entities can move refined metal outward. The arbitrage channel is constrained. So Shanghai reflects what large industrial buyers are actually paying for physical silver, without cash settlement shortcuts. China is the world's largest industrial consumer of silver. Solar, electronics, EVs, semiconductors. The physical clearing price in Shanghai is nearly $10 higher than the Western paper reference. Over time, paper and physical markets do not remain disconnected indefinitely. When convergence happens, it historically moves toward the tighter physical market, not the synthetic one. Now look at the calendar. Today is April 20th. May 1st is first notice day for COMEX May contracts, 9 trading sessions away. May open interest currently represents roughly 241 million ounces. Registered inventory, 77 million ounces. 3 consecutive months have seen heavy delivery demand. January saw record deliveries. February followed with elevated volume. March deliveries consumed around 60% of registered inventory. At the same time, the Shanghai premium creates an incentive to pull metal east instead of depositing into COMEX. Anyone taking delivery at $79.98 and moving metal into the Shanghai system at $89.58 captures nearly $48,000 per 5,000-ounce contract before costs. That incentive exists today. And there's another variable approaching May 1st. China's sulfuric acid export restrictions. Approximately 75% of global silver production comes as a byproduct of copper mining. Sulfuric acid is essential in copper processing. Chile, the world's largest copper producer, imports significant sulfuric acid from China. Supply restrictions increase processing costs and potentially constrain copper output. If copper production slows, byproduct silver supply declines. So on May 1st, two things align. COMEX delivery cycle, potential upstream supply friction. Now zoom out further. The Silver Institute's World Silver Survey 2026 confirms a 6th consecutive annual structural supply deficit. Since 2021, approximately 762 million ounces have been drawn down from above-ground inventories. Since mid-2025 alone, around 200 million ounces have exited COMEX depositories. Silver supply is inelastic. When silver prices rise, miners don't suddenly open silver mines, because most silver comes from copper, lead, and zinc operations. New primary silver discoveries are rare and expensive. Exploration investment was suppressed for over a decade when silver traded at $20 to $30. You can't instantly turn on new supply. Industrial demand, solar panels, EVs, electronics, does not disappear because the future's price fluctuates. Now let's address the counterargument honestly. The India import freeze may simply be administrative. The authorization is typically renewed each year. When renewed, shipments clear and imports resume. The 13% COMEX coverage ratio has existed for months without triggering default. Exchanges use tools like exchange for physical premiums and cash incentives to manage delivery pressure. Shanghai premiums have persisted before without forcing Western repricing. Silver is already up nearly 18% in 1 month and over 50% in 6 months. Momentum is strong. Pullbacks are possible and likely. These are valid points. But structural imbalances don't disappear because short-term volatility exists. Here's the summary as of today. Roughly $1.3 trillion in silver paper exposure globally. COMEX registered coverage near 13%. India's import channel temporarily frozen. Shanghai paying nearly $10 more per ounce. May 1st delivery cycle approaching, 6 consecutive years of supply deficit. Byproduct supply vulnerable to copper disruption. The paper reference price is $79.98. The physical clearing price in Asia is nearly $90. Eventually, either the premium collapses or the paper price rises. Commodity markets don't tolerate persistent structural arbitrage gaps forever. When convergence happens, it tends to favor the constrained physical market. The key question isn't whether silver will pull back in the short term. The question is whether the underlying supply-demand imbalance is being fully reflected in the current paper price. Right now, there is strong evidence that it is not. Invest with discipline. Focus on structure, not noise.